It's easy to look at companies like Facebook and Alibaba and understand how it is that they make money. Yet banks have always been intimidating to many, with most laymen happy to arrive at the conclusion that they lend money. I know nothing about banks either, but I think it would be interesting to see how much I can understand about how banks work, because our lives will inevitably become more intertwined with banks over time, and it may help overcome the anxiety when thinking about these giant institutions if we have some understanding of how they work. Because banks are so complex and vary greatly in terms of what they do, I thought it would be good to start with a single case study, specifically Citibank. This video is an attempt to get a basic understanding of how Citibank makes their money. Looking at their annual report in the financial year 2021, my initial instinct is to look for how they classify and group their different operations. The easiest method of classification is by categorizing their work by region, including North America, Europe, Middle East and Africa, Latin America, and Asia. But this geographical classification isn't very useful. Another way of characterizing its businesses is by looking at the reporting structure of their operations, which is a reflection of how the firm monitors their own businesses internally. The problem with this reporting structure is that it doesn't provide much insight into how one segment may be different to another. For example, to a novice like me, the security services segment sounds like a division that deals with investments, which could be into stocks, bonds or commodities or gold. But then there are also other divisions that are specific for equity markets and fixed income markets, so that doesn't help my understanding at all. Instead, I found it easiest to actually look at the income statement in their consolidated financial statement to get a full summary of where the revenue comes from. The first section is interest revenue and interest expenses. These are referring to all the lending and borrowing that takes place in the bank, which is usually what we associate banks with. In order to have capital to work with, the bank requires individuals and corporations to deposit money with the bank. To entice them to do so would require an attractive enough interest rate so these individuals or corporations don't decide to put their money elsewhere. This is what the interest expense represents. It is the expense that the bank has to pay others for them to be willing to deposit their savings with the bank. On the other hand, the bank can use the money it now holds and lend it to someone else, either through corporate loans or credit card loans. These loans usually charge a higher interest rate, so not only can it be used to pay back the depositors that have left their money with them, but can also be used to generate some additional profit for the bank. Therefore, the net interest income is the sum of all the interest that the bank has earned from lending money to others, minus all the interest that they have to pay to their depositors. The other sources where a bank makes its money from can be grouped into non-interest revenues. This part of a bank's business does not involve the bank directly borrowing or lending money, and therefore doesn't include interest. The first group is the commissions and fees. This group of revenue sources can be further broken down into many small chunks. For banks such as Citi that operate an investment bank, it will naturally include the fees for its investment banking services. Teams within this segment help companies sell shares either by going public on a stock market or by privately selling equity to other investors. They can also help these corporations sell interest-bearing debt to investors. This process is known as underwriting, where the investment bank helps its clients raise debt or equity. All of this requires a lot of research to understand the finances of their clients in order to know how their shares should be priced when they go public or how much interest they should be expected to pay on their debt. Therefore, not only does the firm make money from underwriting the equity or the debt, but also through its advisory services, where their expertise is used to guide clients through these offering processes. Citibank is a brokerage that makes money through commissions. When their clients decide they want to buy new shares on the stock market, they usually send an order to their broker, who then purchases those shares on their behalf, either through a stock exchange or over-the-counter markets. This is a complicated process because money is not usually transferred automatically from one account to another, even though that appears to be the case on our bank accounts. Brokers have to turn that promise to buy something into the actual movement of money from the buyer to the seller's bank accounts to complete the transaction. This process is known as clearing transactions. Other than plain stocks and bonds, the brokerage can also provide the sale of mutual funds and other investment products such as annuities for clients to invest in. By facilitating all these transactions on its brokerage platform, Citibank earns revenue by charging a commission. As a retail bank, Citibank has individual customers like you and I that do business with them. We can open a savings account with the bank and deposit money with them. The bank in turn earns deposit-related fees whenever we require the bank to perform actions within our accounts. This could be transferring money somewhere else, or just from withdrawing money from fixed deposits before it reaches its expiry date, which incurs a penalty fee for us. Retail banks also have credit cards, which earn a fee from merchants whenever customers decide to use their credit cards for payment. Customers may also have to pay annual fees for credit cards with special benefits, or pay a penalty if they exceed their spending limit. Transaction fees can be broadly applied to almost all areas of finance, such as international fund transfers, national and international payments, and other trade services as well. Corporate finance fees are similar to investment banking fees, where a fee is earned by helping companies acquire capital in order to maintain or expand their businesses, usually by underwriting loans. Citibank also sells insurance plans to its customers, earning a distribution revenue from third-party insurance companies for marketing and selling their third-party insurance policies, or by earning insurance premiums directly from selling their own insurance policies. The last of these fees is for loan servicing. When one company has to regularly pay interest to another company through a loan, these regular payments are facilitated by banks. The banks have to issue monthly payment statements, maintain records of payments and balances, and will charge a fee for these services. The next major group of revenue are the administration and other fiduciary fees. These mainly consist of the custody fees and the fiduciary fees. When individuals and corporations make investments, they usually want to keep those safe with a bank. Again, the bank will charge a fee for keeping custody of these assets and will be in charge of safekeeping them, settling their transactions, keeping record, and reporting tax on those items. Fiduciary fees also entail the bank taking temporary ownership of a person or corporation's assets, whilst custody fees entail the protection of those assets and the minimizing of the risk of theft or loss. Fiduciary fees include trust and investment management services, where the fiduciary is given the right to manage those investments, either to increase its value or to protect it from depreciation. Fiduciary fees are not only incurred through safekeeping, but are also asset-based, as their role is to preserve the value of those assets. Principal transactions refers to the actual investments made by the firm, either using their own money or on behalf of a client. These activities are either to help generate additional profits from the capital that they own, or to hedge against risks that the bank has exposures to. These include interest rate risks from central bank policies, foreign exchange risks from geopolitical issues, equity risks that originate from the stock market, or commodity risks from products such as natural gas or crude oil. Revenue from these trading activities are generated through the gains and losses in their trading portfolios. The bank can also serve as a market maker. Instead of helping their clients buy stocks on the public stock exchanges, a bank may buy those shares ahead of time when they are cheaper and then sell them to the clients when a new order is sent at a higher price. So this covers the main gist of how Citibank makes money. But to just categorize these sources of revenue may not be very useful to understand where and what type of clients Citibank is successfully serving or not. In many occasions, clients would seek to use more than one service provided by the bank. In fact, these sources of revenue usually do not exist on their own, which is why banks like Citi adopt their own reporting structures that are targeted to the major types of services they provide to cater towards different types of clients. The two major umbrella categories in Citi are the institutional clients group and the personal banking and wealth management segment. The institutional clients group focuses on large corporate bodies, institutions, and public sector establishments. Services that cater towards their needs consist of banking, which entails helping corporations acquire capital, markets, which entails aiding corporations navigate through the different financial products to help achieve their investment goals, and services, which comprise of the crown jewel segment for Citibank, their treasury and trade solutions. This segment focuses on helping its clients manage their capital and facilitate their cross-border transactions that are of increasing importance in our globalized economy. Interestingly, one of their major clients is Alibaba, who Citibank have helped develop their global payment processes to enhance their international e-commerce business. Personal banking focuses on individual clients like you and I, offering retail banking services, which are essentially all the services that we expect when we walk into a branch of a bank. Since Citi's new CEO, Jane Fraser, has taken helm, the firm has reoriented their personal banking segment to focus on their US consumers, in an attempt to get rid of their inefficiencies when they used to focus on international consumers as well. The main services offered include credit cards, loans, and mortgages, as well as investment services and products. The global wealth management segment caters for individual clients that have greater net worths. There is the private bank that fulfills the needs of the ultra-high net worth clients and family offices, and then the tier below it, which is the Citi Gold and Citi Gold private client, who offer premium services to high net worth and affluent clients as well. This video is an attempted breakdown of the operations that Citibank undertakes in its businesses. Though it is intimidating to try to comprehend the complexities of the financial industry, with patience there may be a chance for laymen like us to be able to unpack each layer one step at a time.